Well, we're back with Midcap Microscope, and today we turn the spotlight on a logistics company. That's GATI. Keep in mind, GATI is part of the B2B segment of the express industry, which has an approximate market size of around 13,500 crore rupees. The market share of the company, well, it's at around that 7% odd market, its focus market, and it's the second largest player after Safe Express. Majority of the company's revenues comes in from Surface Express, while the remainder comes in from supply chain management solutions, Air Express, as well as the e-commerce verticals. Now, in terms of the stock price, well, the stock has nearly tripled from the lows that we saw in 2020. But it's still close to around half of what it was at its peak a few years ago. Now, as is the case in various instances that we have seen in the stock market, a change of guard, that's what spurs sentiment. And with All Cargo Logistics Limited now holding a bulk of the promoter holding, well, in fact, the street was quite enthused. Keep in mind, conversion of the outstanding warrants, well, will take All Cargo Logistics holding past that 50% odd mark. But it's not just sentiment. The financials as well have improved. The revenues have been gradually improving. The margins are scaling towards those high single-digit mark, while the debt is reduced by close to around 100 crores. And just going by the company's plans, well, it can be virtually debt-free as it plans to exit its cold chain business as well as sell some of its other non-core assets. And the company has undertaken various measures in the past year that includes on focus on asset-light business model, which by the way is ROCE accretive, and also focused on margin improvement. Its core Surface Express business revenues, well, it clocked around 300 crores in the fourth quarter of last fiscal. That's the highest ever and 22% higher than what they did on an average in FY20. GATI has laid out its aspirations for the next couple of years. But achieving these goals, well, that's something that needs to be tracked very, very closely as the company looks to wake up from its slumber and outperform the industry after underperforming for the last few years. Now, the company continues its focus on margins as well as ROCE improvement. But the big question is, can it deliver close to around 1,300 crores in terms of revenues in FY23 with double-digit margins, which, by the way, will still be lower than what TCI Express does as their margins are in the high teens. But keep in mind, there is some valuation cushion. The stock trades at around 13 times EV per EBITDA. Well, that's nearly around half of what TCI Express does trade at. Keep an eye out on this one as the street wonders whether or not it'll be an express delivery. For now, though, you take note of the standard disclaimer that's up for you on the screen.